Today, we're not talking about if the next financial crisis will happen. History already answered that. We're talking about how it will happen. And the uncomfortable truth is the next financial crisis will be digital, not physical. What if I told you the next financial crisis won't start with people lining up outside banks? There won't be panic in the streets. There won't be empty ATM machines on the evening news. Instead, it will happen silently. No explosions, no headlines screaming crash, just frozen accounts, denied transactions, disappearing access, all happening behind screens. What makes this shift even more critical is how deeply financial behavior is now shaped by digital habits that most people rarely question, because convenience has slowly replaced awareness and speed has replaced understanding. So when people tap a screen to pay, invest, borrow, or transfer money, they assume the system will always respond, always work, always allow access. But systems don't fail gradually anymore. They fail abruptly, and when they do, the average person realizes too late that they never truly understood the infrastructure behind their financial life. Because digital finance abstracts risk away from the user, hiding complexity behind friendly interfaces and reassuring notifications, which creates a false sense of security that everything is stable simply because it looks stable. Yet stability in a digital system is conditional, dependent on servers running, network syncing, compliance thresholds being met, liquidity algorithms staying balanced, and trust remaining intact across millions of interconnected participants. And once even one of those conditions weakens, the response is not human judgment, but automated restriction, automated throttling, automated freezes, because machines are designed to reduce risk, not to preserve individual freedom. And this is where many people misunderstand digital finance, assuming that technology makes systems more resilient, when in reality it often makes them more brittle under stress. Because human systems bend while automated systems snap, and during the next crisis, the most shocking realization for many won't be market losses, but the discovery that access itself is a privilege, not a guarantee. That moving money, using money, or converting money requires approval from layers of invisible systems that operate beyond public debate or democratic input. And this creates a psychological shock as much as a financial one, because people are emotionally attached to the idea that their money is theirs, when functionally it exists as an entry in a database governed by rules that can change overnight, and those rules will change rapidly during a crisis, always justified by stability, safety, or protection, which sounds reasonable until you are the one waiting for permission to pay rent, cover medical costs, or move savings to protect purchasing power. And history shows that financial rules are always rewritten during moments of stress. But digital systems allow those changes to be enforced instantly and universally, leaving no room for adaptation at the individual level. And this is why the next crisis will feel confusing rather than chaotic, quiet rather than dramatic. Because instead of crowds and noise, there will be notifications, delays, customer support queues, and vague explanations that point to technical issues or temporary measures, while confidence slowly erodes beneath the surface. And confidence is the real foundation of any financial system, because money itself has no value without belief, and digital money depends entirely on trust in institutions, software, and governance all at once. And when that trust weakens, even slightly, people rush not to withdraw cash, but to move digitally, to shift funds, to rebalance, to protect themselves. And that digital rush happens faster than any physical bank run ever could, overwhelming systems that were never designed for synchronized global action. And this creates a feedback loop where protective measures trigger fear, fear triggers restrictions, and restrictions confirm fear, accelerating the crisis without a single dramatic event. And while policymakers will respond with reassurances and technical language, the average person will feel a growing sense of helplessness, not because they lack intelligence, because the system no longer speaks a language they can interact with directly. And this disconnect between users and infrastructure is one of the most underappreciated risks of digital finance, because complexity concentrates power upward while dispersing responsibility downward, meaning no one person feels accountable when access is restricted, delayed, or denied. It's simply the system. And systems don't apologize, they just execute. And this environment rewards those who think ahead rather than those who react emotionally, those who understand that digital finance requires planning for access, redundancy, and flexibility, not just returns. Because the goal during a crisis is not to be right about markets, but to remain functional within them, to maintain the ability to transact, adapt, and respond while others are stuck waiting. And this is why awareness matters more than prediction, because no one needs to know the exact trigger of the next crisis to prepare for its structure, just as you don't need to know when a storm will hit to understand whether your house is built to withstand it. And the uncomfortable reality is that many financial levers today are optimized for efficiency, not resilience. Streamlined for normal conditions but fragile under stress, relying on single points of access, single platforms, single assumptions about stability, and when those assumptions are tested, the system will not pause to educate or explain. It will simply enforce its rules, leaving individuals to adapt in real time, which is never the ideal moment to learn how finance actually works, especially when emotions are high and options are limited. And as digital finance continues to expand, integrating payments, investments, credit identity, and data into unified ecosystems, the distinction between financial risk and digital risk will disappear entirely, because outages, errors, policy shifts, or cyber disruptions will have direct economic consequences, not in theory but in everyday life. affecting groceries, transportation, healthcare, and employment, all mediated through systems that assume constant connectivity and compliance. And this is why the next crisis won't feel like a collapse, but like a tightening, a gradual constriction of options that forces people to confront how dependent they have become on structures they don't control. And while some will dismiss these concerns as pessimism, history consistently shows that financial progress always introduces new vulnerabilities alongside new efficiencies, and those vulnerabilities only become visible under pressure. When incentives shift from growth to preservation, from openness to control, and from flexibility to enforcement, and in that environment, preparedness is not about rejecting technology, but understanding its limits, recognizing that digital systems are tools, not guarantees, and that financial independence in a digital age is less about secrecy or escape and more about informed participation, adaptability, and realistic expectations of how systems behave when stability is no longer assumed. As this digital transformation accelerates, another subtle but powerful shift is taking place that most people underestimate, and that is the normalization of constant financial surveillance, because digital systems don't just move money, they observe behavior, analyze patterns, score risk, and assign trust levels continuously, and in stable times this feels harmless or even helpful, offering fraud protection, convenience, and personalization. But in times of stress, those same tools become instruments of control, because risk models don't understand individual circumstances. They respond to probabilities, correlations, and historical data, which means during a crisis, the safest action for a system is often to restrict first and ask questions later, creating situations where entirely legitimate users find themselves flagged, delayed, or locked out simply because their behavior deviates from an algorithm's definition of normal. And the irony is that during crisis, abnormal behavior becomes rational behavior. People move funds, change patterns, seek safety, but algorithms interpret that rational response as a threat, which further accelerates restrictions, and this cycle creates a digital version of panic that doesn't require fear-driven crowds, only machine-driven thresholds. And once those thresholds are crossed, there is no negotiation, no explanation, no human discretion in the moment, just automated responses designed to protect the system as a whole rather than the individual within it. And this highlights a fundamental difference between physical and digital crises, because physical systems break visibly, giving people time to react, while digital systems fail invisibly, leaving users confused, frustrated, and powerless, unsure whether the problem is temporary, personal, or systemic, and that uncertainty is psychologically exhausting, eroding trust not through shock but through prolonged ambiguity. And when trust erodes slowly, people don't revolt, they adapt quietly, accepting limitations they would have rejected outright in calmer times, which is how temporary measures become permanent features. And this pattern repeats throughout financial history. But digital infrastructure makes it easier than ever to normalize restrictions without resistance, because inconvenience can be framed as safety, delays as protection, and loss of autonomy as stability. And over time, people internalize these trade-offs, trading control for reassurance, even as the underlying risks remain unresolved. And this is where the digital nature of the next crisis becomes especially important, because it won't challenge the system through collapse. It will reshape behavior through constraint, subtly redefining what people consider normal access to their own resources. And as these constraints increase, the gap widens between those who understand the system's mechanics and those who only experience its interface, and that gap determines who adapts quickly and who is left waiting, not because one group is smarter, but because one group anticipated that access itself could become a variable, not a constant, and this anticipation allows for flexibility in thinking, planning, and decision-making that becomes invaluable when options narrow, because during digital disruptions, the most important asset is not capital, but optionality, the ability to respond rather than react, to choose rather than comply by default. And optionality is hardest to build in a system designed for efficiency over resilience, where everything is optimized for speed, cost reduction, and scale, leaving little margin for error when conditions change. And this is why the digital financial system feels incredibly strong in good times and unexpectedly fragile in bad ones, because it relies on continuous confidence and uninterrupted functionality, two things that cannot be guaranteed during periods of systemic stress. And while policymakers and institutions often focus on preventing crises through regulation and oversight, they rarely address the lived experience of users navigating restricted access, delayed funds, or opaque decision-making, because those experiences are seen as acceptable side effects rather than core risks. Yet for individuals and small businesses, access disruptions can be more damaging than market losses, because they affect daily operations, obligations, and survival, not long-term balance sheets. And as digital finance becomes more embedded in employment, healthcare, housing, and social systems, the impact of access restrictions extends beyond money into quality of life itself, making financial stability inseparable from digital stability. And this convergence creates a future where financial literacy must include technological literacy, not at the coding level, but at the systems level. Understanding that finance is no longer just economics, it is infrastructure, and infrastructure failures are rarely fair or evenly distributed. They affect those with the least flexibility the most, while those with preparation absorb the shock quietly, widening inequality without dramatic headlines. And this is why the next crisis may not produce a single defining image or moment, no collapsed bank logo or stock market crash to market's arrival, but rather a gradual shift in how people interact with money, a normalization of friction where there used to be fluidity, and a growing awareness that the rules governing digital finance are not fixed laws of nature, but adjustable parameters shaped by incentives, risk tolerance, and power dynamics. And once people realize that, their relationship with money changes permanently, becoming less about growth and more about continuity, less about optimization and more about survivability. And while some will resist this shift emotionally, clinging to assumptions formed in an earlier financial era, others will adapt pragmatically, recognizing that the goal in a digital financial system is not to eliminate risk, which is impossible, but to understand where risk hides, how it manifests, and how quickly it can materialize. Because digital crises don't give warnings, they give symptoms, and by the time symptoms are obvious, the window for easy adjustment has already closed, leaving only constrained choices. And this reality doesn't mean the system is doomed or inherently malicious. It means it reflects the priorities embedded within it, priorities that favor stability at scale over flexibility at the edge, efficiency over empathy, and predictability over individual nuance. And understanding those priorities is essential for navigating what comes next, because the future of finance will not be decided solely by markets or governments, but by the interaction between humans and the digital systems they increasingly depend on, systems that will continue to evolve, consolidate, and automate, bringing incredible capabilities alongside unprecedented vulnerabilities. And in that environment, the most dangerous assumption anyone can make is that tomorrow's financial stress will look like yesterday's, because the tools have changed, the speed has changed, and the consequences of being unprepared have shifted from visible loss to invisible limitation, which is far harder to recognize, resist, or recover from once it takes hold. Another layer that deserves attention is how dependency on continuous connectivity has quietly become a financial requirement, because digital money assumes constant access to the internet, functioning devices, verified identities, and uninterrupted system uptime. And when any one of those breaks, financial life pauses, which is a profound shift from earlier eras when money functioned offline, anonymously and independently of infrastructure. And this dependence creates new forms of vulnerability that rarely get discussed, because they don't fit traditional financial risk models. Yet during disruptions, they become immediately visible, as people discover that even temporary outages can cascade into missed payments, penalties, lost opportunities, and reputational damage that lingers long after systems come back online. And this fragility is amplified by the consolidation of services, where banking, payments, credit, investments, and identity verification are increasingly bundled into a small number of platforms, creating efficiency but also concentration risk, because when a dominant platform experiences stress, regulatory scrutiny, technical failure, or liquidity concerns, millions of users feel it simultaneously, not as a headline event, but as friction in their daily transactions. And this friction accumulates quietly, shaping behavior as people begin to self-censor financial actions, delaying transfers, avoiding movement, or staying within perceived safe boundaries to avoid triggering restrictions, which subtly alters economic activity at scale, slowing circulation, reducing risk-taking, and reinforcing caution across the system. And while caution sounds prudent, excessive caution driven by uncertainty can itself become destabilizing, because economic systems rely on confidence to function smoothly. And when confidence is replaced by hesitation, even strong fundamentals can weaken, creating a self-fulfilling slowdown that feels technical rather than emotional. And this is where digital crises differ so sharply from physical ones, because they don't rely on fear spreading through crowds, they rely on uncertainty spreading through interfaces, dashboards, and automated messages that provide information without clarity, leaving users guessing about intent, duration, and resolution. And humans are remarkably tolerant of hardship when they understand the rules, but deeply stressed by ambiguity, especially when livelihoods depend on timely access to resources. And this stress doesn't always manifest as panic, it manifests as disengagement, compliance, and lowered expectations, all of which reshape the financial landscape without resistance. And over time, this normalization of restricted access changes how people define financial security, shifting it away from ownership and toward system approval, where security means being considered low risk by algorithms rather than being independently resilient. And that shift has long-term implications for behavior, savings, investment, and even career choices, as people prioritize predictability over opportunity, stability over growth, because the perceived cost of falling outside system norms feels too high, and this dynamic can slow innovation, reduce mobility, and entrench existing power structures, not through explicit policy, but through systemic incentives embedded in digital infrastructure. And while these effects unfold gradually, they become most visible during periods of stress, when the gap between system priorities and individual needs widens, revealing whose interests are protected first and whose are deferred. And this revelation often surprises people who assume neutrality in technology, forgetting that systems reflect the values and risk tolerances of those who design and govern them. And in finance, those values often prioritize systemic stability above all else, which makes sense at scale but can feel harsh at the individual level, especially when safeguards activate without warning or recourse. And this is why preparation for a digital financial crisis is as much psychological as it is practical, because understanding how systems behave under pressure reduces shock, frustration, and reactive decision-making, allowing individuals to respond thoughtfully rather than emotionally, and emotional responses in digital systems are often punished unintentionally, as rapid changes in behavior can trigger risk flags, compounding problems rather than solving them, and this creates a paradox where the natural human response to uncertainty becomes counterproductive within automated frameworks, reinforcing the advantage of foresight over reaction. And foresight doesn't require predicting specific events, it requires recognizing patterns, such as the tendency of systems to centralize during crisis, to tighten controls before loosening them, and to expand oversight in the name of stability, patterns that repeat across history regardless of technology, but which technology accelerates and amplifies. And as these patterns play out, the distinction between temporary emergency measures and long-term structural change becomes blurred, because once systems are reconfigured for higher control and monitoring, reverting to looser frameworks feels risky to institutions, even if conditions improve, leading to a ratchet effect where controls increase over time but rarely fully reverse. And this gradual tightening can go unnoticed by those focused only on market performance, returns, or headlines, yet it shapes the financial environment more profoundly than any single crash, because it alters the rules of participation rather than the value of assets, and rules matter more than prices in determining who can act and when. And as digital finance matures, these rule changes will increasingly be implemented through code rather than legislation, through updates rather than debates, making them faster, quieter, and harder to challenge, which places a premium on individual understanding and adaptability, not as acts of defiance, but as forms of self-preservation within complex systems. And this doesn't mean rejecting digital finance, because its benefits are real and transformative, but it does mean engaging with it consciously, recognizing that convenience is never free, that speed trades off with resilience, and that abstraction hides risk rather than eliminating it. And when people internalize these realities, their approach to money evolves from passive usage to active stewardship, where questions about access, contingency, and dependency become as important as returns or interest rates. And this shift in mindset is what ultimately separates those who feel blindsided by digital disruptions from those who navigate them with relative calm. Because calm comes not from certainty, but from familiarity, from having considered scenarios that others dismiss as unlikely or uncomfortable. And while no preparation can eliminate all risk, especially in interconnected systems, thoughtful preparation can reduce vulnerability, shorten recovery time, and preserve agency during moments when agency feels scarce. And in a digital financial world, agency is the most valuable asset of all, because it determines whether you are an active participant in change or a passive recipient of system decisions. And as the financial system continues its evolution toward greater automation, integration, and control, that distinction will matter more than ever, shaping not only individual outcomes but the broader character of economic life in ways that will only become fully visible when the next period of stress tests assumptions that currently feel unshakable. The most important lesson from all of this is not that technology is dangerous or that the financial system is about to collapse, but that the nature of financial risk has fundamentally changed, and pretending otherwise is the real danger. The next financial crisis will not look like the past because money itself is no longer physical, local, or slow. It is digital, centralized, and instant, which means disruption will arrive quietly, through restricted access rather than empty vaults, through algorithms rather than crowds, and through system decisions rather than personal choice. In this new environment, financial security is no longer just about how much money you have, but how reliably you can access it, move it, and use it when conditions are stressed. Those who assume the system will always function normally will be the most shocked when it doesn't, while those who understand how digital finance behaves under pressure will adapt faster, stay calmer, and preserve their options. This is not a call for fear, panic, or rejection of technology, but a call for awareness, resilience, and intentional thinking, because progress without understanding creates vulnerability, and convenience without preparation creates dependence. The future of finance will reward people who ask better questions, diversify access, think beyond interfaces, and recognize that control, flexibility, and optionality matter just as much as returns. If you want to navigate the next financial era with confidence rather than confusion, now is the time to rethink your relationship with money. Not after access is restricted, not after rules change, and not after choices narrow, because by then it's no longer preparation, it's reaction. Stay informed, stay adaptable, and remember this: in a digital financial world, resilience is freedom, and awareness is the strongest form of wealth.